Interest rates are finally falling. So the real question isn't what is the Fed doing, but what are you doing with your ETF portfolio before this window closes? If your money is still parked like it was in a high rate world, you might be missing one of the most important moments of this cycle to reposition. Not by gambling, but by making a few smart, beginner friendly tweaks that change your long term outcome. For the last couple of years, the story was simple. Cash looked attractive, bonds got beaten up, and a small group of giant growth stocks did most of the heavy lifting. Now the script is flipping. When interest rates fall, the entire pricing system behind stocks, bonds, and real estate shifts. Bonds start to recover. Sectors tied to growth and credit unlock new potential, and suddenly safe cash becomes less appealing while risk assets quietly get more interesting. The goal of this video is to walk through what that actually means for your ETFs, asset class by asset class, and give you actionable, practical moves you can consider right now. Let's start with the basics. Interest rates are simply the price of borrowing money. When that price is high, mortgages, car loans, and business debt are expensive. Companies delay projects, consumers delay big purchases, and overall growth tends to slow. When rates fall, loans get cheaper, monthly payments shrink, and it becomes easier and more attractive for people and businesses to spend, invest, and expand. That easier money environment is what slowly filters through into the returns of different ETFs in your portfolio. Every major asset class has its own relationship with interest rates. Bonds are directly tied to them because their yields move with the broader rate environment. Stocks are affected more indirectly through changes in financing costs and investor appetite for risk. Real estate feels it mainly through mortgage rates and property financing costs. When you hear rate cuts, don't think of it as one single event. Think of it as turning three dials on your portfolio: the bond dial, the stock dial, and the real estate dial. Each dial reacts differently, and understanding those reactions is where your edge comes from as an ETF investor. Let's talk bonds first, because this is where falling rates can be a quiet gold mine for patient investors. The core rule is simple. Bond prices and interest rates move in opposite directions. When rates fall, existing bonds with higher locked-in coupons become more valuable. That means bond ETFs holding those older, higher-yield bonds can see their prices rise on top of the interest they pay out. If you watched your bond ETFs drop during the hiking cycle, you're looking at the mirror image now. The same mechanism that hurt you before can help you in a falling rate world. There's one big concept you need to grasp here: duration. Duration is essentially a measure of how sensitive a bond or bond ETF is to changes in interest rates. Higher duration means more price movement when rates change. When rates were going up, high duration ETFs felt painful. But in a falling rate environment, that sensitivity works in your favor because prices can climb more as yields grind down. This doesn't mean you go all in on long duration bonds, but it does mean that a portion of your fixed income sleeve can justifiably tilt a bit longer if your time horizon is measured in years, not months. Think of two bond ETFs sitting on your screen. One is ultra short term, designed to behave almost like cash, low volatility, low sensitivity, just quietly paying a modest yield. The other is a core or intermediate bond ETF with a mix of government and corporate bonds and a higher duration. In a rising rate world, investors hid in the ultra short option. In a falling rate world, that same cash style ETF becomes less appealing as yields slip, while the longer duration ETF offers more potential for both income and capital gains. As rates fall, part of your strategy can simply be to slowly rotate from defensive short-term bonds into more traditional core bond exposure. Now let's flip to equities. Historically, falling rate environments have often been positive for stocks overall. When rates drop, the return on cash and short-term instruments falls too, which pushes investors to look for higher returns in equities. Lower borrowing costs improve company profit margins and make it easier to refinance debt. Future earnings look more valuable when discounted back at lower interest rates, which is especially helpful for growth-oriented businesses. But this isn't just a stocks up story. Within the stock market, some sectors and styles tend to benefit more than others when rates fall. Cyclical sectors, like financials, industrials, and consumer discretionary, often gain as the economy economy responds to cheaper credit and stronger demand. Financials can see improved loan volumes even if their margins shift. Industrials enjoy cheaper financing for big projects. And consumer discretionary businesses benefit when households feel more confident and have more room in their budgets as borrowing costs ease. Small cap stocks are another interesting piece of this puzzle. Smaller companies usually rely more on bank loans and debt markets to grow. When rates fall, their interest expenses can drop meaningfully, freeing up cash flow for expansion, hiring, and innovation. That's why small cap ETFs often have periods of strong outperformance after rate cut cycles, especially when the cuts are seen as supportive rather than a response to a full-blown crisis. If your current ETF portfolio is heavily tilted toward large cap, broad market funds, adding a modest small cap ETF allocation can be a simple way to plug into that potential upside. At the same time, you cannot ignore the megacap growth story. Growth companies, especially in technology and innovation-focused sectors, are valued primarily on earnings expected years into the future. When discount rates come down, the present value of those future cash flows rises. That's one reason why big tech and growth-focused ETFs often enjoy strong tailwinds when the rate environment shifts from aggressive hikes to stable or falling. The trick for you as a beginner or intermediate investor is not to swing from all tech to no tech, but to avoid being over-concentrated. A smarter move is to maintain your broad, growth-tilted core while deliberately adding exposure to sectors and styles that were left behind during the last phase. Now, let's bring real estate and REIT ETFs into the picture. Real estate is one of the most rate-sensitive areas of the market. When mortgage rates fall, home buyers can afford larger loans or lower monthly payments, which supports demand. For commercial real estate, lower financing costs make it easier to own, operate, and develop properties profitably. Listed REITs, which own portfolios of income-producing properties, feel this through better refinancing terms and often renewed investor interest in steady property-backed income. In a falling rate environment, REITs can benefit in two ways at once. Their cost of debt can decline, and investors searching for yield may rotate back into them as bond yields compress. That makes them attractive as part of an income strategy, but they are still equities and can be volatile. The key is to view rates as part of your diversified income and growth mix, not as a replacement for every bond you own. A modest slice of a diversified REIT ETF can give you real estate exposure and attractive distributions without forcing you to pick individual property companies. So, what does all of this mean for an actual ETF portfolio you can hold in a brokerage account? Let's imagine a very common starting point: 70% in a broad equity ETF, 20% in a short-term bond or money market ETF, and 10% in cash, with maybe no real estate at all. That setup made a lot of sense when rates were rising and cash yields were high. In a falling rate world, that same setup can quietly become suboptimal. Cash yields drift down, short-term bonds don't offer much price upside, and you're missing out on some of the potential benefits from a more balanced bond sleeve and from rate-sensitive equity segments. Here's a more falling rates-aware structure many investors might consider as a starting framework, adjusting to their risk tolerance. Keep a broad equity ETF as your core, but carve out a portion, say 10 to 20% of the equity slice, for targeted exposures like small caps and cyclical sectors. Shift some of your ultra short-term bond or cash allocation into a core bond ETF with moderate duration, and potentially a smaller allocation to longer duration or core plus bonds if you can tolerate the extra price movement. Then introduce a reasonable allocation to a diversified REIT ETF as part of your overall equity and income mix. The important thing is that you're not chasing headlines. You're systematically aligning your portfolio with the new macro backdrop. Instead of trying to predict every central bank decision, you accept a simple reality. If the general direction of rates is down, cash becomes less attractive, traditional bonds become more interesting, and certain equity segments have room to run. Your job is to make sure your portfolio isn't still anchored to last year's environment. There are also behavioral advantages to setting this up properly. When you have a thought-out allocation, say a mix of equity, bond, small cap, and REIT ETFs, you can lean on a rule-based process like annual or or semi-annual rebalancing. If stocks rally hard on rate cut optimism and suddenly make up more of your portfolio than intended, you systematically trim a bit and top up bonds or REITs. If bonds enjoy a big run as yields drop, you skim off the gains and reload into equities or hold extra dry powder. This structure turns volatility from something you fear into something you can use. If you're just starting out, all of this may sound complicated, but it doesn't have to be. You don't need 15 ETFs and daily macro analysis. You need a handful of well-chosen building blocks and a basic understanding of how they behave when money gets cheaper. Think in layers: a broad equity ETF as your base, a core bond ETF for stability and interest rate exposure, a small cap or cyclical tilt for growth in a recovery, and a REIT ETF for diversified property-backed income. Once those are in place, you can automate contributions each month and let the rate cycle work in your favor over time. And remember, falling rates do not mean zero risk. If inflation flares up again or growth weakens more than expected, markets can react violently in the short term. But the right response to that uncertainty is not doing nothing. It's being intentional. Make sure you're not trapped in yesterday's allocation, overstuffed with cash and ultra-short bonds, while the rest of the market quietly prices in a new era of cheaper money. So here's your challenge. Open your portfolio and ask 3 simple questions. 1. Am I overweight cash and short-term bonds for a world where yields are likely moving lower? 2. Is my equity exposure diversified enough to benefit if small caps, cyclicals, and growth all have their moments during this easing cycle? 3. Do I have any real estate exposure at all, or am I missing one of the key income assets that benefits from cheaper financing? If the honest answer to any of those questions makes you uncomfortable, that's your signal. You don't have to overhaul everything overnight. Start with one small change. Add a core bond ETF, introduce a small cap ETF, or give rates a modest seat at the table. Then build from there, step by step. Falling interest rates are not just headlines for economists. They're a quiet, powerful shift in the background of your entire ETF portfolio. Use this moment, adjust your mix, and let the new rate environment become a tailwind rather than a missed opportunity. So here's where this all comes together. Falling interest rates are not just background noise. They're the moment your ETF portfolio either quietly levels up or quietly gets left behind. If you've watched this far, you already think differently from the average saver who just shrugs and waits for the economy to fix things. You now understand how cheaper money ripples through bonds, stocks, and real estate, and that alone puts you miles ahead of most investors who only look at price charts and headlines. The next step is to turn that understanding into a simple, concrete plan. First, look at your fixed income side. If you've been hiding in cash and ultra short-term bonds because rising rates scared you, start nudging a portion of that into a core bond ETF with real duration. You're not trying to time the exact bottom in yields. You're simply accepting that when rates fall, long and intermediate bonds finally get a tailwind instead of a punch in the face. Even a measured shift, say a small percentage of your portfolio, can make a difference over the next few years. On the equity side, stop thinking in terms of one magic ETF. Keep your broad, low-cost core, but ask whether you're willing to give a bit more room to the parts of the market that historically respond well to easier money: small caps, cyclical sectors like financials and industrials, and quality growth businesses that can compound steadily in a low-rate world. You don't need to guess which stock wins. You just need to own the basket and give it time. Meanwhile, use REITETFs as a deliberate, sized piece of your plan if you want property-backed income that benefits when borrowing gets cheaper. Most importantly, decide today how you will behave in this new rate regime. Will you chase every new macro headline, or will you automate contributions, rebalance on a schedule, and let the math of compounding do what it does best? The investors who come out ahead from this rate cycle won't necessarily be the ones who called every pivot correctly. They'll be the ones who understood the direction of the tide, tilted their ETF mix accordingly, and then had the patience to stay the course. So after this video ends, don't just click away. Open your brokerage, write down your current allocation, and choose one upgrade you'll make this week: a core bond ETF if you're light on fixed income, a small cap or cyclical ETF if you're overexposed to mega caps, or a REIT ETF if you've completely ignored real estate. Then commit to a simple rule like monthly investing and annual rebalancing. Interest rates are falling. The landscape has changed. The only real question now is whether your ETF portfolio will change with it, or whether a year from now you'll look back and wish you'd acted when the opportunity was right in front of you.